So tonight we're going to talk about student loans and what you guys need to know. I have been partnering with College Ave now for a few years, and I really appreciate their dedication to providing education to families. Actually, we do more than just student loans. We work with College Ave throughout the whole year and do different pieces, lots of different educational pieces. We write articles, and it's not even only about student loans. It's about the whole process. So I really appreciate their sponsorship. And tonight we're going to talk about loans in general. You'll learn a little bit about College Ave, but this is really to educate people about the process, because we want to make sure that you go in to this process and that you know what you're looking at, that you're asking the right questions, and you need to be educated and you need to do your shopping. And then hopefully, I'm sure you'll take a look at College Ave Student Loans as part of the process, and you'll be able to make an educated decision. So Angela, welcome again. I'd love if you could tell people a little bit about yourself and about College Ave.
Sure, I'd be happy to. And Debbie, I will say we love what you do, and we love really the forum that you provide, where you can give better in-depth information to really help educate people beyond just simple blog posts or things along that line. So thank you for what you do. We love working with you. I am the Chief Marketing Officer for College Ave Student Loans, and we are a private lender. So often we may be able to play a role for you if federal student loans don't fully meet your need. And we're going to talk more about what all that means tonight.
And one other thing I'm going to let you guys know, let's see if I can put it in the chat if I have it saved. Yep. We have a download where you can, copy the link now. We'll send it in an email later on tonight or tomorrow. And it just is some important points that we're summarizing that we're going to talk about tonight. So this is recorded. You can always go back and watch it. You can take the download also, so you don't have to feel like you have to take notes the whole night. So these are just kind of different ways that you can get the information you need and then use it after tonight's session. Okay, so we're going to talk about student loans. We're going to talk about the FAFSA, different types of federal loans, and then dig in more specifically to private loans and the different features that you need to know about it, how you apply, and all the timeline related to getting a private student loan. Okay, so Angela, tell us why it all begins with the FAFSA.
So the FAFSA is really the way that you raise your hand and say that you would like to be considered for any aid. And when I say any aid, that means federal student loans, work study, certain grants from the federal government, and really many schools also use it as a gating factor and whether to consider you for aid from their institution as well. Like they could even be merit aid. So the FAFSA is how you raise your hand and say, please consider me for any type of funds. And it is also the way that you would apply for those federal student loans. So this is the start point. And then everything goes from here. So many of you on this call may have already completed the FAFSA, particularly if you have a student entering in the fall. If you haven't for the fall semester, it's not too late. But I would encourage you in the future, it always opens in October. And some aid is first come, first serve. So if this year you're maybe a little later than you want to be, make a note on your calendar so that for next year, you can get there in October or soon after when it opens.
And this is why we emphasize kind of throughout the whole year, and particularly in October and November when it's FAFSA season, why it's so important to fill it out. You may be a family that doesn't get need-based aid, and I understand that that's probably a lot of the situation what families are in, but you still want to do the FAFSA because it's going to be, and this is the phrase that everyone uses, the gateway to federal student loans. So and we're going to show you, we're going to encourage, if you need to borrow, your students should borrow the federal loans first. And they can only borrow the federal loans if you've filled out the FAFSA.
That's right. And just filling out the FAFSA doesn't commit you to taking that loan.
Right.
It just makes sure that you're in line if you ultimately want to receive it.
And one last comment is you will have to fill it out every year if your student wants to take, and you and your student want to take out those federal loans. And again, you might decide that you're not getting any need-based aid, maybe you can cover, years 2 through 4. That's great. But also there's no harm in filling out that FAFSA and having the opportunity to make that decision, anytime you want during the year. Okay, so people have filled out the FAFSA. A lot of people, again, probably on this session, you've gotten financial aid awards, and in those award packages might have been a description of the direct federal loans, and there are 2 types of direct federal loans.
Yes. So these are the direct loans that are in the student's name. And we'll start on the subsidized side, and then we'll move to the unsubsidized, which is really the more common one. But on the subsidized side, that particular loan is need-based. So they are going to take your family's financial need into account to decide if you can qualify for a subsidized loan. And what subsidized really means is that the government is not charging interest, or they're covering the interest while the student is in school. So the benefit of that loan is that there's no interest accruing while the student is in school. So certainly that is the more appealing one, should you qualify for it based on need. And the way that you would find out if you qualify that is that it would be included in the award letter. And it is entirely possible, it is school by school. So it's possible that you may qualify for that at one school, but not another. But that's really what subsidized comes down to. I think the important things to remember there are, it is financial need based. And it really, what it means is that no interest is going to accrue, no interest is going to be charged while the student's in school. So that's the less common of the student direct loans. The more common one is the direct unsubsidized loan. And what that really means, again, the difference here is interest. And the interest is starting to accrue as soon as the money is issued on the unsubsidized loan. The unsubsidized loans also, they're really not need-based. Essentially, virtually any student who's enrolled at least half-time is going to qualify for an unsubsidized loan. So you don't have to worry that, it's sort of a myth that people think, well, I make too much money, I won't qualify for anything. The amount of income that you have is not going to affect your eligibility for an unsubsidized loan.
And in fact, actually, there's a woman who wrote in the chat that, and I don't know the full situation, Donna, you can email me later, but she said her daughter subsidized and unsubsidized loans were removed from the award letter. And I mean, subsidized loans might have been affected, but everybody, as Angela just said, has access to the unsubsidized loan. So the fact that they remove them from your letter doesn't mean anything. You can still get them, and you should contact the school.
Contact the financial aid office. The only limiting factor, or the common limiting factor, I guess I would say, on the unsubsidized loan would be if you already have covered all of your cost of attendance for the school. So let's say that the school gave you merit aid or something along that line, or you received an outside scholarship from your company or something along that line that ultimately covered the full cost of attendance. That's really one of the only instances where, they would determine that you didn't qualify for that. Or if the student is not enrolled at least half time, you do need to be enrolled at least half time to qualify for that.
Yeah. So Donna, you should follow up on that and definitely
Yes,
contact
absolutely.
the school's financial aid office.
But those are the factors to keep in mind.
Okay. And then there are limits, on the federal student loans, and they change year to year.
There are, and I'm really going to focus on the dependent scenarios here, because it actually is relatively difficult, quite frankly, for a student to qualify as an independent undergraduate. If you think that you have a student, or if you are a student who you believe may be in that situation, I recommend you go to studentaid.gov and research the guidelines on the federal program. But it is, I'm going to say, relatively uncommon. So we're going to focus on the dependent undergraduate side. And you can see that there are annual limits on those direct loans. And these annual limits are really for both of those types we just described. So think about it as you could get up to $5,500 as a freshman in unsubsidized loans. And if you do qualify for any of that to be subsidized, it would be a portion of that $5,500. So that $5,500 is really the maximum for all of the direct loans, and only a portion of that could be subsidized. As you can see, that limit increases each year. So as a freshman, you can only borrow $5,500. As a sophomore, you can borrow up to $6,500. And then for junior and senior year, you can borrow up to $7,500. But you can see that certainly these are the best place to start. If you need to borrow, you always start with these federal loans in the student's name. but you can see how this may not cover your full costs.
And a question we normally get, and also I'll just ask it now, is about if you don't take it the first year, can I decide that my student's not going to take a federal loan, but we decide the following year we need it. What happens to the money that they didn't take the first year?
Yeah, so let's just use that freshman to sophomore scenario. If you don't elect to take the $5,500 freshman year, as a sophomore, you can still only borrow $6,500 that year. You can't reach back. You can't say, well, I didn't take the freshman loan, so I'd actually like to take more money this year. You're still limited to that individual limit that you see here each year, regardless of what you chose to borrow the year before.
So I encourage people to do two things. One is try and plan out, I mean, to some extent, how you're going to cover the 4-year costs of college. Sometimes, a lot of times, people just focus on how am I going to pay for the first year? And then, it's the feeling of I'll figure it out the next year. But, in this case, you really want to look at all 4 years. You want to look at the loans that are available all 4 years. You might want to think about the interest rate environment that we're in right now. And it's uncertainty, but it's actually, it is uncertainty, but the certainty is unfortunately that the rates are probably going to go in an upward direction. So kind of put that all together. And one kind of recommendation is your student can always take out the federal loan. And if things work out great and you can pay it off, you can pay it off early. So, it's always, sometimes if you're not sure, better to take it out. And then, at the end of the year, if you can pay it off, great. At least you had that flexibility.
That's right. And there is no prepayment penalty. So if you were to do that, and if you find that you can pay the loan off early, or you can just simply return the money, you don't use it, you're not going to be charged any fees to do that.
So Angela, do you want to talk a little bit about the how the interest rates on these loans are set and what they're at right now?
Sure. So the loans are, all of the rates on these loans are fixed rates. They get set once a year for any of the loans that are going to be issued during that year. One thing I do want to clarify is Debbie has the correct rates on the screen for you. So the rate is going to be 4.99 and the origination fee is 1.057. If you go to the federal website today, you will still see last year's rates. They don't typically update it until July 1st, but these are the rates that you should expect because the loans will actually be going out the door after July 1st.
So these direct rates, and you're going to see it when we talk about the Parent Plus loan, the federal loans have origination fees, and we'll talk about what they are. This origination fee is somewhat minor, but the Parent Plus loan is heftier. So, that's going to be part of people's decisions about which loans to go after.
That's right.
Okay, the Parent Plus loan, which is the other type of federal loan that's available.
Yes. So once you've taken the direct loans, an option to fill the gap is the Parent Plus loan. It can only be taken by a parent. It is fairly restrictive in terms of who can get it. It really is down to a parent. I think there are some other rules around legal guardianship, that type of thing. Again, go to the federal website if you have a situation along that line. But for the most part, think parent is who's going to be eligible to receive that loan. Again, the student does need to be enrolled at least half time. And it will be solely in the parent's name. So the student will not be legally responsible for the Parent Plus loan in any way. It will be solely in the parent's name. You start to applying for the Plus loan. The first step is the FAFSA. And then there is an additional form, which is often made available by your school. If you would like to apply for the Parent Plus loan, I believe you can also find that form just directly within the federal portal as well, where you completed the FAFSA, but schools will often provide you that link if you would like to complete the full Parent Plus application. The one thing I'll mention, and then I can talk to the rates and borrowing limits, but while we're talking about applying, the Parent Plus loan does have some very basic credit criteria. So the student loans we talked about, the direct student loans, do not really evaluate anything from a credit perspective. They're just checking to see, is the student enrolled at least half time? Have they not?
And you know what, Angela, the one thing we didn't emphasize is those loans are not co-signed.
That's
So,
right. They are solely
which
in
is
the
a big
student's
deal.
name. The
Yeah.
student has full responsibility for those. That's right. And so the direct loans don't require any type of credit check. The Parent Plus loans are going to have a basic credit check. They're not necessarily looking for a minimum FICO or anything along that line, but they are looking for things like, did you have a federal loan in the past that you didn't repay? So there are a few things that would make you ineligible potentially for a Parent Plus loan, but it is many people qualify for it. It also has a fixed rate. And again, that rate gets set once a year for all the loans that are going to be dispersed in that year. And the anticipated rate, Debbie has it here for you, is 7.54 for the upcoming year. And it does have a higher origination fee than we discussed for those student direct loans. The origination fee is over 4% for the plus loans, which, depending on the amount you're taking out, can, add a significant cost to the loan. So it is something you want to understand. And the maximum you can receive here is the cost of attendance. So there are not those aggregate limits like we discussed on the student loans. You can fill the rest of your gap theoretically using the plus loan if you're comfortable doing so.
And just to point out, as Angela mentioned, so the rate this year is 7.54. The origination fee 4.228, and I don't have the exact math, but I'll just do an estimate. My guess is it probably adds a basis point to the 7.54. So you're really looking at a rate that's over 8%. And I say that because when we talk about other types of loans, you don't want to compare the 7.54% because that's not the true cost of the loan or the true interest rate. You're going to want to compare, and we can do the math and send it out later, something over 8%. That's the true comparison when you're looking at apples to apples interest rates.
That's right. And that is the easy way to compare it. That's sort of the good rule of thumb of how that would impact, how the origination fee would impact the rate, so that you can compare it to other options.
And then one more thing I'll point out is, and Angela and I were talking about this before we started the session, all schools do it differently. Some schools might have packaged the Parent Plus loan in your financial aid award letter. And so it might have just looked like another loan, that's the loan you had to take. This is truly, all these loans are a choice. Everyone highly recommends that if there's any borrowing to be done, the student's going to take the federal direct loan first. But then, quite honestly, it's like a decision tree after that. You have to decide whether or not you want to go down the Parent Plus loan trail, a piece of the tree, or you want to look at private student loans. And Angela, I missed it if you said it, like one of the major decision points is really about whether or not whose name the loan is going to be in.
Responsibility. And I think that's the important thing to remember here before we move into describing the private loans, is that everything we've discussed, the first ones we started with were only the student's responsibility. They're only the student's legally responsible for direct loans. With a Parent Plus loan, only the parent is legally responsible for that loan. So you're taking on that full responsibility versus sharing it with the student. When we get into the private space, we'll talk more about that sharing it with the student option. I did see one other question too about the Parent Plus loans, and do you need to apply every year for these? Yes. Just like with the direct loans in the student's name, you submit that FAFSA every year, and you would need to submit the Parent Plus loan application every year.
So technically, these are every year, these are separate loans. So they will have, that's why the interest rate is set every year. That's right. And that's why you have to apply for it. It's unfortunately, it's a collection of lots of different loans that come together over the 4 years.
That's right.
And somebody asked, is there a pre-approval for a Parent Plus loan?
There is not one for the Parent Plus loan that I'm aware of, but what I would suggest is go to studentaid.gov, because there really are just a few reasons why you would not be eligible for a Parent Plus loan. And you could probably look at the criteria and pretty easily understand, does that apply to me or not? So if you just look at what the rules are at studentaid.gov, you could probably have a fairly good sense of whether you will qualify for this or not. Many do. The other piece, I think somebody asked about a prepayment penalty. There's also no prepayment penalty on the Parent Plus loan.
And so, Angela, I don't know if you have the answer to this, but somebody is asking if a parent takes out the Parent Plus loan and they pass away, do you know what happens to the loans?
I don't recall on Plus if there is permanent forgiveness, if there's permanent disability or death forgiveness. I don't recall on the Plus, Debbie. I want to say that there may be, but
I
would
want to say,
go
I
to the
think
federal
so, but I
website
don't
and
want to
verify that.
Yeah, yeah, I agree. Okay. Oh, good question. For these particular loans, and we'll talk about it also for private loans, do you have to apply for each semester? Or can you apply for the full year?
So the way that you only need to fill the FAFSA out one time each year. So I'm just going to use that October date because it's when the FAFSA opens. So if you fill that out in October, you're covered for the full year. You may need to communicate with the financial aid office. If, for example, you decide not to take the loan for the first semester, but you'd like to access it for the second semester, you may just need to contact the financial aid office to facilitate that. But you don't need to complete the FAFSA again every semester. And we'll talk a little bit more about this borrowing by a semester or by an academic year in the private space as well. But that's how you would access the federal loans. You only need to fill the form out one time each year.
Okay, so let's move on and talk about the different types of private loans. And then we'll also talk about how they compare to the Parent Plus loan.
Yes. So the first point here, let's start on the private student loan column. So we'll go back to that piece that I mentioned about sharing responsibility, because what we often find is, once people have exhausted the federal direct loans in the student's name, then they have those paths in front of them and they may be considering Parent Plus, but one of the gating factors for them is often, I don't want all of this in my name. I want the student to have skin in the game. I want the student on the loan as well. I want the student to also share responsibility for this debt. And if you want to go that path, then that's often when people will consider private student loans, because they are in the name of the student, but they typically require a cosigner. Cosigners are often a parent. It doesn't have to be a parent. It could be any creditworthy adult who wants to share that responsibility for funding the student's education. So parent is common, but not required to be a parent. So both parties are taking accountability, taking legal responsibility for the debt. And again, these are like Plus, where they do typically allow you to borrow up to the full cost of attendance. So you can usually fill the remainder of the gap. With the private student loan, you're not going to hit those same, annual limits, like that $5,500 annual limit we showed you on the federal direct loan in the student's name. The interest rates are based on credit risk. So it's risk-based pricing is what you may hear. And so when you apply, you will agree that the lender is going to pull your credit and review your credit profile, and your interest rates are going to be based on your credit profile. Let me pause there. Debbie, is there anything else you want me to hit on those points, or I can go deeper into cosigner release and that type of thing?
Somebody is asking, just kind of good timing. Is the loan also based on the student's credit profile or only the cosigner's credit profile?
If both people are applying, it is both people's credit profiles will typically be taken into account. Now, the cosigner is often the one with the income and a stronger credit, so that will often have more of an influence, so to speak, but both parties are going to be considered on the loan, but they're going to look at both people who are applying together.
And so I guess maybe you can talk a little bit about, obviously, if there's two parents willing to co-sign, how should they decide who should be the co-signer?
Sure. Well, if you know that one parent has better credit than another, I would typically recommend you go that route, just because better credit is going to get you a lower interest rate. It's going to, ensure that you get an approval, and it's going to get you a lower interest rate. If you're not sure, or if you're both very similar and so you're just not certain who would be better, we're going to talk about pre-qualification in a little while. So maybe bookmark that in your mind, but you may be able to go and have a soft credit inquiry done and just get a sense of who might be the better cosigner from an interest rate perspective.
Okay, so have it talk a little bit more about a cosigner release, and when that might be able to happen, and how that's something that happens with the private student loans, but it's not something that's going to be available for a Parent Plus loan.
That's right, because really the Parent Plus loan, there's only one person on it. There is no cosigner. With a private student loan, when you have a student and a cosigner, this is really unique, quite frankly, in the financial world. If anybody's ever tried to get off of a mortgage or any other type of joint credit product, you often can't. But private student lenders recognize that the cosigner is often coming to the table while the student is in school, with the expectation that the student is going to graduate, they're going to have the value of that degree, the utility of that degree, and then the student will likely be able to take on the repayment of that loan, over the rest of the life of the loan. So it is a very unique aspect of private student loans, but many lenders do offer cosigner release. The important thing and what that would do is remove the cosigner from the loan, but allow the loan to exist as it is with the same terms that it has. And the student can just go on repaying that loan on their own, but the loan is no longer on the cosigner's credit if you are approved for cosigner release. The important thing to look at for cosigner release is, one, decide if that's important to you, because not all lenders offer it. So if it is something that is important to you to have available, you want to make sure that the lender that you're considering has a cosigner release policy. The second piece of it that I would recommend is making sure that you understand what their criteria is. Is it going to just be at the lender's discretion? Is it basically you can apply, they'll look at it and tell you whether or not you're approved? Or do they have clear criteria so you will know when you've met the criteria to be approved? How much of it is a black box and how much of it is clearly defined? Make sure that you have a sense of that so that you have the right expectation about when you might be able to be released and what hurdles will need to be passed in order for you to get approved for that.
And so, and that's really important. That's kind of one of those, fine details that we tell people to really look into and make sure they know. And, honestly, I know people have just finished the college admissions process with their student, which was a lot of research. You might have had different spreadsheets of colleges and due dates and all that type of stuff. This is a little bit of a mini version of that. I encourage people to kind of make a list of everything that they're learning about the different lenders and about the loans, and even have a little spreadsheet about what the interest rate is that you got from a different lender and what their different features are. And that's the cosigner release is a really important feature to understand the details of. Every lender kind of approaches it differently. But most lenders, it's not like your student's going to be able to graduate and you're going to be able to be off the loan, because the purpose is to get that they're coming up with some criteria to determine that your student is more financially stable and strong. And that's why the cosigner can be released.
That's right. There needs to, any of the criteria, what it's really looking for is just a demonstration that the student is now able to stand on their own, and that they're going to be able to handle this debt on their own.
And so, the last bullet point under the private student loans, which kind of applies to everything we're talking about, is it's really important to talk to your student about interest rates, about how they work, and to estimate. And maybe Angela, you can talk about how they can do it at College Ave Student Loans website, but estimate what the monthly payment might be of your student's loan. And again, this goes back to my comment about 4 years. You can, you might know the dollar amount of the loan for this year and definitely, estimate what the monthly payment would be when your student graduates just for this year. But that's why it's also important to look at all 4 years. And look at what that monthly amount's going to be at the end of 4 years of various loans that they might have to take.
Yes. And I think we're getting lots of questions about when do payments start and what are your options. So that's really relevant, I think, to the calculator you just described, Debbie. So we have kind of two different flavors of calculators on our site. One is a more generic calculator that if you would just like to understand the costs of maybe a different offer that you received or something along that line, you can just plug in some basic information about a loan. It's a good way for your student to probably understand the basics of how long am I going to be paying this back? What will those monthly payments be? How much will I pay in interest? It's a good starter tool, I guess I would say. And then if you're interested in better understanding the College Ave product specifically and all of those options, and I am going to speak about those in one moment, we have other more specific calculators that will show you the options on our loans and the outcomes of different choices that you can make. And those different choices that you can make, yes, the student could wait until they leave school to start paying. That's what we would call deferred. And that's an option on our product. So you could choose the deferred option, and then the payments will not become due until after the student graduates or leaves school. We do also have other options, though, where we encourage you to even start making as little as $25 payments during school. Gets people into the habit. It addresses some of the interest and limits the amount of interest that's accruing on the loan. Or you can choose to make just the interest payments, so you're preventing any interest from accruing. Or you could start making full principal and interest payments immediately. Full principal and interest payments are going to be the lowest cost, but you're going to have monthly payments due right away, but it'll be the lowest overall total cost of the loan. The other choices that you can make on our loan is how many years you take to pay it back. So we offer 5, now I'm questioning myself, 5, 10, 12, and 15, I believe. So we offer different choices of a different number of years you can take to repay the loan. And by toggling back and forth between when you start making payments, how much you start paying while the student is in school, or if you start paying while the student is in school, and how many years you take to pay back, you can really dial in on a monthly payment that you can handle during school and after school. And that's really what it's designed to do, is help people manage their budget, and then also in managing their budget, keep their total costs as low as they possibly can. I will just reach back on the federal loan side. 10 years is the standard repayment. There are ways to extend that, but 10 years is sort of the standard on the federal side. But on the private side, some lenders offer choices like we do. Although I think the number of choices that we offer, the number of configurations is more than you will find many places.
So before we move on, do you want to just touch on what a private parent loan is and how it compares to everything, all the other loan options we've been talking about?
Sure. So the private parent loan is very much like the PLUS loan. You can take up to the cost of attendance. It actually does not have to be, we call it a private parent loan because that's what most people understand it to be, and they compare it to Parent Plus, but it actually is more like a sponsor loan. It doesn't necessarily, again, have to be the parent. It could be an aunt, it could be some other creditworthy adult who, again, wants to take full responsibility for the student's education. So it is only in that person's name. It is not in the student's name. You can cover up to the full cost of attendance, but these don't have origination fees. So, and it is not a single fixed rate for everyone. It is based on your credit worthiness. So if the person who wants to take full responsibility for this, paying for the student's education, has strong credit, they may find that they can actually get a cheaper option on the private side by avoiding that origination fee and possibly getting a lower interest rate than the Parent Plus loan. So really, the way I always think about it is, once you've moved to the point where you're considering Parent Plus, you want to at least entertain the option of either also private student loans or also private parent loans, and at least just make sure that you've considered all of your choices and selected the one that is best for you.
Okay, so you talked a little bit about, how, your credit score is both a factor potentially in the interest rate, but what happens going through the application process? What are lenders, or when do they pull the actual credit report information, or what can you do? What information can you get before you get to that point?
So some lenders, not everyone, but some lenders, including College Ave, offer a pre-qualification. And it is what we call a soft inquiry. It does not affect your credit score to only pre-qualify, or only if you see pre-qualify, or if you see soft inquiry, then it's not having any impact on your credit score. It's also not a guarantee, but it is going to give you some sense of, am I likely to qualify if I complete a full application? And what will my rate range, possibly look like? You can usually get a better sense of, within the big range, where might you fall within there based on your credit. So it's not a guarantee, but it's often very quick, very easy. And it just gives you a sense while you're in your shopping phase before you decide to apply. Once you decide to complete a full application and apply, a lender is going to pull your credit bureau, and it will be what is considered a hard inquiry. And hard inquiries do have some impact on your credit score. Not as much as positive payments, not as much as some of the other factors, but inquiries on your credit report will affect your credit score.
So, now is a perfect time to, as you're starting to understand this, you could go to different lenders and find out what your pre-qualification range is. As Angela said, there won't be any impact to your credit score and won't be a guarantee, but it's kind of like directional. It's
That's
giving
right.
you a sense of where, what your smaller range might be, because if you see, and, we even include the ranges, it's a huge range because it's showing you the lowest possible and the highest possible of what a lender is going to offer, but you're going to fall somewhere, in the middle. So, again, definitely encourage people to start doing that type of research now. And then you can do that research and narrow it down to potentially a few lenders where you do want to apply to get the exact interest rate that you're going to be offered. And when you do that and start really applying and they do a hard credit hit, if you apply to multiple lenders within a few weeks' time, it actually won't be as detrimental to your credit score because they're all looked as one hit because the bureaus know you're shopping.
Yes, they understand, they can identify that you're shopping for student loans. They see that the multiple inquiries are student loan inquiries, so they understand that what you're doing is shopping. You just want to try to do that within a 30-day window so that they capture that as shopping activity.
And the reason why we're sharing all of this information now and education, and we actually did a similar session, was it the beginning of May, I think, is because and again, Angela and I talked about this before we started, the time creeps up. And what happens is you get your tuition bill, and sometimes there's not that much time after getting the bill to when it's due. You are lucky if you have 4 weeks. And a lot of times it could be like less than 4 weeks. So we're trying to help you understand this process now and kind of nudging you on to do the research now so that you're not in that panic stage of when the tuition bill comes.
And Debbie, we had a question about when the money gets dispersed to the school, which I don't know if it might just make sense to just address it here because we're talking about these timelines.
Mm-hmm.
So that's a really interesting question because part of the student loan process is you're going to apply, you're going to understand if you're approved for the loan or not. You're going to accept the terms of your loan and say, yes, I'm interested in taking this. And then the lender is going to communicate directly with your school to certify the loan. And what that means is that we go to the school and we say, is the student enrolled? Do they still need funds? Have they already covered their cost of attendance, or do they still need money? Basic things like that. And then the school will echo back to us that information. Yes, they're enrolled. Yes, they need this money. And the school will tell us what schedule they want the money on. So when you ask the question of how quickly can it be dispersed, it could be dispersed in theory within 7 to 10 days after you have your approval, but that's dependent on the school finishing the certification process and the school telling us they want the money that quickly. In many instances for the fall semester, the school will actually set the disbursement for early September. So the reason, once they know they have a loan in queue, they will often consider your bill paid. That's school by school, but once they know that the loan is coming, they will often consider it paid, even though they've technically asked for the money to come later. But the reason that's important to remember is because in some cases you're applying for money for students that are living off campus, or for books or a laptop, funds that are actually going to go to the school and then get refunded to you to cover those expenses, and you won't receive them until the school receives the money and then refunds the money to you. So it's sort of a nuance in the how quickly does it get dispersed. It's really less about how quickly can we do it, and it's more about when does the school ask us to send the money to them.
Okay. So we went over some of this, but one thing I realized that we didn't talk about related to interest rates, Angela, is the different types of interest rates, a variable versus a fixed.
Sure. Yeah. So all of the federal loans that we discussed, they all have fixed rates. They will update those at least once a year, but once you receive your loan with your rate, it doesn't change, it's fixed.
For the life of that loan.
For the life of that loan. On the private side, you often have a choice of either variable or fixed interest rates. Variable rates are going to be tied to a market index. So LIBOR used to be the common one. Now it's SOFR. And really what that means is that the interest rate on your loan is going to move with the market. So it could go up and down as the market moves. And if you're shopping loans at the same time and you're looking, the starting rate of a variable loan is typically going to be lower than what you could get in a fixed rate at that time, because the loan can move as the market moves. A fixed interest rate is going to be set for the life of the loan. So it's not going to change. Your payments are not going to change. But if you compare it to that variable rate, you're going to see that it will be higher than the starting variable rate at the same time that you're shopping.
And is there a little bit of a rule of thumb of why somebody would take a variable rate versus a fixed rate? If they maybe can pay it off faster, or?
Every situation is different, but I would say, think about the size of the loan and how long you intend to keep it, because the size of the loan and how long you intend to keep it is going to correlate with how much you might be affected by those market changes. So if you're going to pay the loan off in a year or 2 years, or you're only borrowing $1,000, then you're not going to see as significant of a financial impact potentially, because the rate either isn't going to have as much time to change, or you're just not paying as much interest anyway because it's a smaller dollar amount. If you're going to take longer to repay the loan, or you're talking about a larger dollar amount, then you could be affected in a different way with those rates moving over time. They may be more likely to move, and changes in the interest rate over time may have a bigger effect if you have a larger loan that that interest rate is being applied to.
And again, we talked about some of this before we got on the session tonight. It's in the news a lot. Interest rates for other types, and just the federal rate is increasing. What do you think people need to think about or factor into the decision about taking out student loans relative to seeing these rates increase?
So really, we are in a raising rate environment right now. If you're not familiar with the moves that the Federal Reserve is making, or the timeline that they're making them on, do a little Googling, because as the Federal Reserve continues to raise their rates, that will affect the cost of borrowing in the private space. So it is likely, all indications are that they're indicating they're going to continue to raise rates. And so private loans and frankly, other things like personal loans, that type of thing, you would expect those interest rates to keep going up. So you may want to look at the timing of when those changes are coming and decide if you want to try to apply before that. The other thing I would recommend is you think about, do you just want to borrow for one semester, or do you want to borrow for the full academic year? So with the private loan, we alluded to this a little bit earlier, but with the private loan, you can choose to either cover a semester at a time or a full academic year at a time. If you choose to pay for the full academic year, the payments that go to the school will be split up by semester. So what I mean by that is, let's just say somebody applies for $10,000 to cover fall and spring. What the school would typically come back and say to us is, send us $5,000 in September, send us the next $5,000 in January. And what is important to know is that you don't get charged interest on the money until it arrives at the school. So for that spring disbursement of your next $5,000, you're not paying interest on that early. You're not paying interest on that until it goes to the school to pay for the spring semester. And if something changes and you no longer need that money for the spring semester, that can be changed. So I would think about, if you think that it's likely that rates are going to go up, I would think about when you applying for the full academic year, so that you're locking in that interest rate now.
So I along with what you're just saying, and I'm thinking, we commented that some schools haven't sent out the tuition bill. It may not be for a few weeks. Can somebody actually apply now, actually send an application, not know the true final cost of what their bill is yet, but estimate it and get the interest rate, and when the bill comes, make any adjustments?
So my recommendation is always err on the side of a higher amount. It's typically easier. There's lots of different points in the process where you can either reduce the amount, or if you take out a little more than you need, you send a payment in. There's no penalty for paying early. It comes off the balance. It's harder to get sort of halfway through the process usually, and then try to go back and increase the loan amount. So yes, you absolutely could apply now if you have a pretty good estimate of what you need. Frankly, I think earlier, once you have a pretty good estimate of what you need, I think earlier is always better, because schools do get bogged down processing a lot of loans at the same time. That would be my recommendation, is to err on the slightly higher side and then reduce it. There are ways to reduce it if you need to. You can either have the school reduce it, you can call the lender and reduce it, but it's just typically easier to bring it down than bring it up.
And we have a bullet point here about like automatic debit payments or getting a discount on the interest rate. Can you explain a little bit about that?
Sure, it is fairly common. So this applies to federal loans, and it also applies to the majority of private loans. Every private loan could be different. It's always good to double check, but it's very common that you can get an interest rate discount by signing up for automatic payments. So it's a great way to know that your payments are being made on time and to get a little bit of a haircut on that interest rate.
So there was a question earlier, and we have here about prepayment penalties and hardship. Let me see what the question is. Is it true? Do private loans not offer forbearance and deferment if you lose your job or can't pay?
No, so it's not in anyone's interest to not have people be able to successfully repay their loans. So private lenders absolutely will work with borrowers. Every lender is different. Every lender may have a different policy and may have different programs available, but every lender, if you're having some type of issue repaying, wants you to call, and they will typically have some type of option that they can offer you. It might be hardship forbearance, it might be deferment, it might be an extended grace period if you just need additional time after graduating college to get a job. There's lots of different programs out there, and really any lender is going to work with you through those programs.
And we talked about, how it's important to understand what the monthly cost would be and, the total cost. So you might be managing the features that Angela talked about to get a certain monthly payment, and then which is good and helpful for your student's budget, but then also know what that total cost of the loan is going to be over however many years you're taking it out, just to understand the trade-offs that you're making.
Yes. And Debbie, I did misquote it. It's 5, 8, 10, and 15.
Oh, right, it's right there.
Option, I think it wasn't popular. So it's 5, 8, 10, and 15. Or my product team will love that I got that wrong.
So these are all the different levers, that you as the consumer can play with, on the loan, how many years you want to take the loan out for, when you're going to start to repay it, whether or not you're going to do a fixed rate versus a variable rate. And you'll see, by the different combinations that you pick, it will impact even, your credit score is your credit score, but you're going to see different interest rates depending on the combination of these factors that I just mentioned.
Yes. And so there's a question here about, is it credit? Do they look at debt to income? Yes. So it is going to be more than just your credit. They're going to look at income, and then debt to income is often a piece of what they will be factoring in.
And somebody had asked, and we can just reiterate this, do you have to apply for private loans every year?
Yes, so you will need to return every year, and part of it is because of that process I described where the school is actually involved in certifying the loan and receiving the funds. That's part of the reason why the cycle sort of starts over for both federal and private every single year. So again, you can do semester by semester for private loans. You could choose to apply individual semesters, or you can do a full academic year at a time, but you really can't do more than that.
And maybe if you don't mind, Angela, to just repeat, because there was a question earlier about repayment terms, like what the different options are again, so that people know, about of whether or not it has to start as soon as the loan, or how long you can wait before a student has to repay.
Yes. So I'll give you my caveat of every private lender is different because they can set their own terms. But at College Ave, we offer 4 different, what I would say, repayment options. So the first is you could just defer the loan. So you could wait to start making payments until the student leaves school.
And I'm just adding in the caveat, interest still accrues
It
while you're
does.
waiting.
Interest does still accrue while the student is in school, but just no payments are due. You can choose that option, and then you can still make payments here or there if you can. There's no penalties if you pay early, but that gives you, that's sort of the maximum flexibility while the student is in school, where there's nothing required, would be the deferred option. The next step up from that is our $25 option. So you can pay as little as $25 while you're in school. You will get, a slight interest rate reduction for that, because it is recognizing that you're starting to make those payments sooner. And like I said, it does get you into a good habit. It gets the student into a good habit, and it will help reduce some of those interest costs that are accruing during school. The next step up from that would be interest only. So you could choose to just pay the interest charges as you go. And that way, when the student leaves school, there is no accrued interest. So they're really just starting after they've left school with no interest accrued. And then the final piece would be full principal and interest payments. And that would just be beginning your full payments right away.
So most of those options are somewhat starting, to pay something right away, except for the first option where you can defer until the student graduates. And is it usually 6 months after they graduate, or
It is.
immediately?
So the grace period would be 6 months after they leave school, before those payments are due. There are some longer grace periods on grad loans and some other specialty loans, but for this audience, 6 months is the grace period for undergraduates.
So there's a question here. Maybe you can talk to the audience of parents, which I'm one of, when you have multiple kids and they might be in school at the same time. How should you handle loans if you're going to have to take out loans for, 2 or more students maybe at the same time, and just any words of wisdom?
It is a great question. That is, again, where I think it's really important to sit down and try to look. I know it's difficult, but to try to look as many years in the future as you can, so that you're planning for both over the course of whether it's 4 years or 6 years or whatever it might be. Because what you will probably want to do is say, well, how do I maximize the federal loans in the student's name? And then if you are going to need to borrow private, you are going to need to co-sign. That's where you might need, you might want 2 co-signers who are trading on and off, or you might want, one co-signer to take the older child and one co-signer to take the younger child. So you might split up, which parent is going to co-sign or when they're going to co-sign. It just takes a little bit of planning to determine, to try to, lay down the best way forward for that. But that is often what we would see, is that parents may sort of divide it that way.
And I guess, we don't like to think about this, but could there be the possibility, particularly in the situation where, a family has 2 students going at the same time and they're taking out loans, that they might hit a limit and not, of what they can borrow?
It is possible. So there are aggregate limits that many lenders will just say, we just can't extend beyond a certain dollar amount to one individual. Honestly, those limits are relatively high. You could certainly reach out to individual lenders if you're worried that you may fall into that category. You can reach out to the individual lender and better understand what those limitations might be. But that can be another reason why it's a good idea to do that split and sort out who's going to be the co-signer for whom, because one individual co-signing for multiple students at high cost schools could be challenging.
So there's a question about, and maybe we could just clear it up. Are loans just for tuition, or will they cover room, board, and books?
They will cover things beyond tuition and fees. So when we talk about the cost of attendance, the school has a calculation for the cost of attendance that takes into account tuition, fees, room and board, and then some of those extra expenses for things like commuting, books, supplies, that type of thing. So yes, loans can be used for above and beyond tuition and fees. They can go up to that cost of attendance that includes those other pieces. And if you're curious about what your cost of attendance is, because it's not tuition, right? It is a different number than tuition. Your financial aid office could help you understand what that cost of attendance number is.
And then there's another good question, which we should definitely clarify. Lori's asking, does everything discussed tonight apply to graduate school too, or just undergraduate?
The majority of what we've discussed applies to graduate as well. What we didn't cover is that there is a grad plus loan, which is similar to the parent plus loan that grad students can take in their own name. So that's something that you would want to research on the federal side from a grad perspective. Once you get into the grad space on the private loan side, grad students may be able to qualify without a cosigner. It depends. So you may see some grad students not needing a cosigner as much as a standard freshman would. And then the other piece is that you'll get into some specialty products. For medical school, there are very different needs than there are for an MBA or a law school. So you will get into sort of the specialty space for some of those niche degrees. But a lot of what we discussed here is relevant for grad students as well.
And I guess just continuing in the discussion of grad students, are parents' income ever factored into borrowing for a graduate school?
So they wouldn't affect the ability for the graduate to qualify for the plus loan. It's really all about the graduate at that point. In terms of whether it would affect the school's perspective on aid, I would want to defer to the individual school and their process on that.
So you talked a little bit about timing, but here is just a clearer slide about, kind of the days, and maybe you could just review it. We are in that 60 to 90 days of getting people to learn the process and to start shopping around.
That's right. So you're in that window where I think it's important to decide what's important to you. Are you considering taking the debt on by yourself? Do you want the student to share responsibility? Do you want options that enable and encourage you to start making payments right away? Do you want deferment? Is cosigner release important? Do you understand what the different rules might be for different lenders? So I think right now you're in that window where it's a good idea to use the pre-qualification tools, look around at the lenders, identify what matters to you, and narrow down your list for who you think you would want to apply to for your final shopping. And then when you, this says 30 to 45 days, but really it is when you have the tuition bill or what you need to borrow, you have a pretty good sense of what you need, go ahead and get those loan applications done so that you can make your final decision on your lender. And that way you can get the money sent to the school. And again, in some cases, they know that the loan is coming. Everything is done, but the money may not go out the door to the school until September or whenever they define that they want it.
And that's when, and understandably, sometimes people get antsy because, they've been approved, but they don't see the money, in their students' portal.
That's right. That's right. We certainly understand that it absolutely is it's a unique aspect of these loans because the money does go to the school. Okay,
I'm just kind of looking through if there's any other questions we might not have covered. There was a question earlier and you kind of reviewed it, but maybe just to mention it again, people are asking for the federal direct loans for their students. Where do they actually apply or fill out the paperwork?
Sure. So in some cases, again, the school might actually give you a link, but you can go directly to studentaid.gov and you can find the link for the FAFSA there.
And, in a lot of this, particularly related to the federal loans, you should feel comfortable calling your student's financial aid office. I mean, your student's going to be going there now, like, they've, enrolled or to put down a deposit. You should use that office to, answer whatever questions you might have, particularly like some of the ones that came up tonight. We can give general answers, but these things unfortunately vary school to school, so it's always best to call the financial aid office directly. Yes, they are your best resource, especially if you have really specific questions about your family situation. They're a wonderful resource. So if you get the loan that has money for books, so this is sort of what I was mentioning earlier. So the loan technically can cover those expenses, but obviously those expenses are not being billed directly by the school. You actually need the money to pay for that. You will get that money. So the whole loan will go to the school on the school schedule, and then the school will refund anything above and beyond tuition and fees to you. And it is important to know how the school is going to do that.
Each school does it differently. They might put it on a student account. They might give you a card. They might cut a check. So if you're getting a refund, if you're borrowing above and beyond tuition and fees and you're looking for that money to come back to you, make sure that you know from the financial aid office how that money will be coming to you. And that's how you would get the money for books. And so in some cases, what you might find is you actually need to buy them first, and then you're almost reimbursing yourself from the loan, depending on your school's timing.
Okay, and I just put it into chat, and I'm going to reiterate, if you want a summary of what we talked about tonight with the important piece of information that you should know, you can download this tip sheet. It just kind of gives you the quick and dirty of what we talked about tonight. So you have a piece of paper to kind of remind yourself, and it actually has a checklist of things that you should be doing as you're researching the student loans. So it's helpful. Again, just another piece of educational information that we put together with College Ave's help. Okay, well, thanks everybody for coming tonight, and thank you, Angela and College Ave, for providing so much of this information. And I really encourage people, watch this again, if you want to make sure that you understand everything we talked about. Download the tip sheet and start researching, gathering your information. I just hate it when I get those like anxious emails that people, feel like they are rushed to make a decision because they might not have started early enough. So here's your chance to start early and get the information you need. And, you can have the time to look at it and then decide, who are we really going to apply to, and then get that information. And then, you'll feel comfortable to enjoy the send off of your student and driving them to school. Or maybe you'll be happy, maybe you won't, but that's an individual family decision. Okay. Thank you, Angela. Good night, everybody.
Thanks, everyone.